My Vanguard Portfolio update. A month of market madness, tariff talks, and temptations to time the market. Hey everyone, and welcome back to this month's update on my Vanguard Portfolio. Now, I don't say this lightly, but wow, what a month it's been. If you're new here, I always kick these updates off by stepping back from my personal investments and looking at the bigger picture. What's been happening in the markets, what's moving the needle, and what we, as long-term investors, can actually learn from it all. Because, let's be honest, short-term noise is everywhere. But if we can learn to interpret it rather than react emotionally to it, we're already ahead of 90% of investors. So, let's get straight into the news and headlines that have dominated the market this month. Then we'll take a look at how my portfolio's performed and what changes I've made, if any. Spoiler alert, probably not what you expect. First up, the biggest news: US-China tariff pause. Now, the biggest story of the month has to be the surprise reversal, or should I say pause, of those US-China tariffs. Yep, after weeks of tit-for-tat tensions, the US government has temporarily rolled back some of the tariffs it had placed on Chinese goods. That alone was enough to send the market into a full-blown rally. You can probably see on screen now that the S&P 500 surged on this news, bouncing hard and fast. As I record this, it's hovering right near its all-time highs. And what's really fascinating is how quickly we've gone from panic to party. I mean, just a few weeks ago, people were absolutely convinced we were heading into a serious market correction, even a prolonged bear market. People were pulling out of equities, stashing cash, buying gold, and now, we're right back to where we were before all this tariff talk began. The FTSE 100, if we flip over to the UK side for a second, is telling a similar story. It's bounced right back to the levels we were seeing earlier this year, almost as if the whole tariff saga never even happened. And that's the thing. This kind of volatility is just part of the ride. The people who tried to duck in and out of the market during all of this have almost certainly missed out on the rally. That brings me to a point I'll return to later on: the temptation to time the market and why it's such a dangerous game. I want to zoom in on what this tariff pause actually means on the ground. A friend of mine runs a small hardware import business in Ohio. For years, he's imported plastic and metal components from China to assemble products that are sold across the Midwest. Back when the tariffs first kicked in last year, he saw his import costs spike by about 25%. Suddenly, a shipment that used to cost $50,000 jumped to $62,500 overnight. He had two choices: pass the cost on to customers, risking losing sales, or eat the cost himself and shrink his margins. Over the months, he's been slowly adjusting prices, but he's also been forced to delay orders or reduce inventory, which hurts sales. Now with this tariff pause, he's cautiously optimistic but says, it's not a reset button. The damage is done for this year. This story highlights why markets rallying on headline news isn't the full picture. Real economic pain takes time to heal. To put this into context, U.S. import prices overall increased by 6.1% last year, the highest jump since 1981, driven primarily by tariffs. That pushed inflation higher, squeezing both consumers and businesses. So while tariff news headlines can make for dramatic swings in the stock market, the broader economy is much slower to respond. The impact on consumer prices and supply chains will take quarters, maybe years, to fully resolve. Tariffs, elections, political leaders, these are all short-term events. At most, a presidential term lasts 4 years, maybe 8. But as long-term investors, we're thinking in terms of decades. I plan to invest through multiple presidents, several governments, endless headlines. None of that should change how I invest. And honestly, once you truly internalize that, investing becomes a whole lot less stressful. I was chatting with my neighbor recently. He's in his early 60s, close to retirement, and has been invested for about 30 years. When he started, the world looked very different. The Cold War was still on, the internet was just beginning, and Apple was a tiny startup nobody took seriously. He told me he's seen dozens of market crises: the dot-com bubble burst, the 2008 global financial crisis, flash crashes, geopolitical scares, you name it. And every single time, staying invested, especially in low-cost diversified funds, was the best move. He's now comfortably retired because he didn't let panic dictate his decisions. That's a real-life testament to the power of long-term investing, and it's why I keep hammering home this message. Now, story number 2 that caught a lot of attention. Moody's, one of the big credit agencies, downgraded the US government's debt rating from AAA to AA. Sounds scary, right? Well, let's unpack this. Credit rating agencies essentially assess how likely a borrower, in this case a country, is to repay its debt. When Moody's downgrades the US, it's saying there's slightly more risk in holding US government bonds. But here's the kicker. The US still has arguably the most stable, liquid, and in-demand government bonds in the world. It issues debt in the world's reserve currency. Investors around the globe still flock to US Treasuries in times of uncertainty. What does this mean in numbers? The US government currently has roughly $31 trillion in outstanding debt. Yes, trillion with a T. This represents about 125% of the country's GDP. So, naturally, some investors and credit agencies are concerned about the ability to service that debt long-term. However, US Treasuries remain the largest and most traded bond market globally, with over $23 trillion in bonds outstanding. According to the US Treasury, foreign investors hold nearly 30% of US debt. That's countries like China, Japan, the UK, and many others. Despite the downgrade, demand for US debt remains strong, and yields have barely budged. This tells me markets are saying, yes, there's risk, but the US is still the safest bet around. Alright, let's shift gears and talk about gold. Something I know a lot of people have piled into recently. Now, as you'll see on screen, gold prices have absolutely tumbled this past month. After a huge multi-year rally that accelerated over the last year or two, it looks like the momentum has finally snapped. Here's my honest view. I think a lot of people jumped into gold when stocks started falling and thought, this is it, this is my safe haven. But now that equities have bounced back, those same people are dumping gold to chase stock market gains. And that, right there, is the definition of short-term thinking. Real-life statistic, gold versus stocks over time. Let's talk numbers for a second. From 1980 to 2023, gold has returned about 5.5% annually on average. The S&P 500, around 10% annually, including dividends reinvested. That difference compounds massively over time. For example, $10,000 invested in gold in 1980 would be roughly $126,000 today. The same $10,000 invested in the S&P 500 would be over $1,200,000. That's the power of compounding dividends and business growth. Let's pivot over to one of the more dramatic stories in the world of individual stocks, Google. A couple of weeks back, Google suffered its biggest single-day drop in history, a fall of around 9% driven by rumors that Apple might be exploring alternatives to Google search using its own AI models. Now, to be fair, that's a big story. If Apple, which controls a massive share of the mobile ecosystem, were to replace Google as the default search engine, that could hurt. But let's take a breath. Google came out that same day saying that search volume was still growing, business fundamentals were strong, and nothing had changed. And what happened after that? The share price rebounded within days. What this means for long-term investors. I always remind myself that businesses like Google aren't fragile. They have deep moats, massive user bases, huge amounts of data, and incredible technical infrastructure. Even if Apple did reduce Google's dominance in search, Google owns YouTube, Android, cloud services, and other revenue streams that make up most of its value. Switching over to the UK now. You might have seen the news about a trade agreement between the UK and the US, removing or reducing tariffs on a few specific products, mainly cars and steel. Fun fact, the biggest goods export from the UK to the US? It's actually cars, mostly luxury brands like Jaguar and Land Rover. So this deal could be beneficial on paper. But let's be honest, the deal was incredibly narrow in scope. Most analysts say it's basically just a formalization of what was already happening. The actual changes are minimal. Still, symbolically, it's significant. It shows the UK is trying to deepen its trading ties post-Brexit. But again, from an investor's point of view, not something I'd base my portfolio strategy on. And one last piece of news from the UK. GDP growth came in at 0.6%, ahead of the forecasted 0.4%. Cue the headlines, UK growth is back, economy roars to life. But here's the thing. These figures are constantly revised. In 3 months' time, that 0.6% could be 0.3% or 0.9%. Who knows? And remember, GDP is always backward-looking. It tells you what was happening, not what's going to happen. It's like driving by looking in the rearview mirror. Okay, let's bring it back to the portfolio. So I have 2 Vanguard accounts, but the main one I focus on is my self-invested personal pension, or SIPP. And the reason is pretty straightforward, it's just incredibly tax efficient. Every time I contribute to this SIP from my limited company, that contribution is a tax-deductible expense. That means no corporation tax, no dividend tax, and no income tax. It just goes straight into the pension. untouched, and starts compounding. Portfolio milestone and contributions. But here's the kicker. More than 70% of that growth has come from regular monthly contributions, not from market gains. This highlights just how important consistency is. I contribute about £1,000 every month, and the vast majority goes into a diversified mix of Vanguard global index funds, covering the UK, US, Europe, emerging markets, and bonds. Even in the recent volatile months, February, March, and April, when the portfolio was down every month, I still kept adding funds. It felt tough watching numbers drop, but the plan is to buy more shares when prices are lower. Classic dollar-cost averaging. If there's one thing this past month has reminded me of, it's how easy it is to get distracted by the noise. Tariff pauses, credit downgrades, commodity crashes, company collapses. The headlines are endless. But none of them should derail a properly thought-out long-term investing plan. If you're investing in a diversified global portfolio, contributing consistently and thinking in decades, not days, then you're doing it right. My neighbor, the retiree I mentioned, told me recently the market is like a roller coaster, kid. It's scary when you're on it, but if you keep your hands up and ride it out, the view at the top is amazing. I think that sums it up perfectly. Thanks as always for watching. Let me know in the comments how your portfolio is doing, whether you stayed invested through the volatility, or if you made any changes this month. No judgment. We're all here to learn. I'll catch you in the next one.